The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and welcome to today's webinar, which is called Avoiding Bad Debt is Better Than Dealing with Bad Debt. Today, we will be learning about why it is important to keep up-to-date information regarding our customers and why it is best to deal with overdue debts quickly. Today's presenter is Mark Smith, who is the New South Wales Sales Manager for National Credit Insurance, NCI, which is a company that provides a comprehensive range of credit services, everything from credit insurance to premium funding for your credit insurance policy. So I would like to welcome Mark and to thank him for taking the time to speak to us today. Throughout the webinar, if you have any questions, please feel free to type them into the questions panel, which is between the polls and chat panels, and I would be happy to read those out for you at the end of the webinar. So that's it from me. So I will now hand you over to Mark so that he can begin his presentation.
Thank you, Yoshi, and thank you all for attending today. I know it's not the most exciting subject, but with the large number of insolvencies that have been happening over the last couple of years, we thought it was quite timely to do a presentation on this. Firstly, I'd just like to start by telling you a little bit about NCI. Sorry, my computer froze. National Credit Insurance is a specialist in trade credit insurance and credit risk management services. We place approximately 65% of the brokered credit insurance market. We've been operating for over 25 years with offices in every major state of Australia. We have 2 offices in New Zealand and we have an office in Singapore. Although we're a specialist trade credit insurance broker, we do offer the full suite of credit management products. We're basically your one-stop shop for credit management needs. Other than credit insurance, our services include mercantile and investigation reports to help companies assess the credit risk of their customers, a credit risk management product which provides clients access to our database of information and ongoing monitoring for adverse information. And we also have a collections department to assist companies in chasing overdue debts. Recently we've also been linked to the Personal Property Securities Register, where we provide advice, registration and management of all your personal property securities. With NCI covering the whole life cycle of credit management, it places us in the perfect position where we can really establish what the economy and markets are doing in regards to trade credit risk, how many companies are under financial pressures and struggling to pay. Now I'd like to show you NCI claim stats for 2013 to date. So far approximately $70 million in claims have been lodged with NCI Trade Credit Insurance, and we only make up 65% of the market. According to ASIC, insolvency stats this year are the highest number on record, even higher than during the global financial crisis. The insolvency statistics for May 2013, just like April 2013 before it, was the highest on record for that month. And as you can see from the graph there, all industries are being affected, but there's certain industries which are more highly affected than others, such as building, construction, electrical, you have your manufacturing, your plastics, and as you can see down there we do have a paper printing stationery category where we've processed over $2 million of claims this year. I believe that would be a lot higher, however we don't have as large a book in paper and printing clients as we do in building, construction and other categories. One of the main reasons being is that the insurers have been not that keen to insure that industry, although things have changed recently over the last 6 months. With this, it provides us with a really good insight of how companies and sectors are travelling, and it also highlights the importance of having good credit management processes in place. The next slide is NCI's Trade Credit Risk Index score, which we release quarterly, and it takes into account a number of factors when we assess credit risk. As you can note, in the 3rd quarter this year, the environment definitely is volatile and deteriorating. This also makes it extremely important to know who you're dealing with. Knowing your buyer. This would be probably the most important step in managing your credit risk. Any loss has a big impact on profits. Fact. Working on 10% margins, a $50,000 loss means you have to sell $500,000 to cover that loss. What this means is you could be working for 2, 3, 6 months for nothing. It's imperative you know your buyer is going to pay. For example, if you were to go to the bank for credit, you would go through a rigorous credit assessment. Why should it be any different for a company granting credit? You need to assess your buyer to limit the chances of non-payment. The first question you should be asking yourself is this new customer coming to me because they have been refused credit elsewhere? A credit application should be completed to establish correct legal entity. The legal entity is the company you need to sue if payment is not received. The three main forms of a legal entity are a Pty limited company, a sole trader, or a partnership, amongst others such as cooperative, government bodies, clubs or associations. A lot of you might come across ABN numbers where it's a trust. You might be aware, but a trust is not a legal entity and you cannot sue a trust. What you need to do is establish who the trustee is behind that trust. The trustee will be in the form of a Pty limited company and they'll have an ACN number or a sole trader or partnership. It is really important on your credit application form that you ask for the ACN number, and if a sole trader or partnership that you ask for date of birth and driver's license number as well. This so we can easily establish who we're chasing if we need to take someone to court. As you're aware, like imagine if you didn't have the date of birth number for someone like Mark Smith, like myself. There's thousands of Mark Smiths out there and it'd be hard who to chase for in courts. For larger credit exposures, it's also beneficial to determine what assets the debtor has and what securities might be warranted to protect against loss. For example, have the debtor complete a director's guarantee. You should always evaluate the risk before extending credit, check trade references, purchase a credit report to assist with this evaluation. If you have a retention of title clause in your terms and conditions, that is where you retain ownership of goods until paid for, these should be registered on the PPSR for these to be valid. I'm not sure if you're aware, but the Personal Property Securities Act came into legislation in January 2012, and all personal securities must be registered on the PPSR for these to be valid. For you guys, this would mean if you have retention of title clauses, these would need to be registered on the PPSR. What this does, it gives you a seat at the negotiating table in the event of a solvency and protects your interests. It puts you ahead of the banks and secured creditors if you have the registration. Having a credit application completed provides you information and authority to firstly identify and verify the entity, establish the applicant's creditworthiness, and it provides a real record. It must also properly be executed and have all the necessary terms and conditions of trade. Knowing who your buyer is not only greatly decreases the chances of not getting paid, but it also strengthens your position in the event you need to take legal action against them. So in summary, the granting of credit does involve risk, but nothing beats a formal credit policy. Ensure you have all the information to make a thorough assessment. You make your best credit decisions when you have all the facts. And when granting of credit, remember the 5 C's of credit. 5 C's of credit: character, capacity, capital, collateral, and conditions. Character analysis. This is basically the impression the customer makes on you. Will the customer pay? Can they be relied on and trusted to repay debts? Is there a history of broken promises if you've been dealing with this customer for a while? What is the debtor's attitude to creditors? Is it honest, open and helpful? Does he work with you when he's got an outstanding debt? Or is it arrogant and aggressive? How experienced are the key managers within the business? Capacity. This is probably the most important factor of those 5 factors. Can the customer pay? Is there cash flow from the business to repay debts and trade purchases? Payment history on other credit relationships. Assess your trade references, credit checks, ledger experience. And if required, don't be afraid to ask for financial statements. Capital. Capital is the money invested into the business. Assess what kind of risk the customer is willing to make to ensure their business succeeds. And the more the customer has personally invested into the business, the more likely they are to work their hardest to make sure the business is a success. Collateral. Collateral is personal and or business assets that the customer is willing to put up as security in the event the business cannot repay its debts. This can be through guarantees. check real estate holdings, determine what securities a business or the directors have given. And finally, conditions and industry characteristics. And I think this is key and important, as noted by those claim statistics. Look at the economy and the customer's industry. What are the conditions affecting other businesses that the customer deals with? Is the customer in a highly competitive industry? Are there pressures on margins? Is he likely to be affected by seasonal factors? Is the business managed well, or is it shaky? Assess the industry and performance of competitors. And how mature is the company? Is it a 12-month-old company, or have they been going for 10 years plus? Asking these questions of the 5 C's of credit will help you make a fully informed decision, and it reduces the potential of bad debts. If you do have a concern with a debtor after doing these assessments, this doesn't necessarily mean you do not have to deal with them. You can impose an initial cash sales only trading period. You can set payment terms at 7 or 14 days rather than the 30 days. You can set a low credit limit subject to review after a period of acceptable trade, or insist on your personal guarantees. Apply interest on overdue amounts. A lot of companies, what they do is offer attractive credit conditions such as prompt settlement discounts or rebates if the customer pays on time or pays early. Do consider trade credit insurance to protect against bad debt, and take security. Be prepared to act on your retention of title. NCI's information reports can basically do this job for you, and it provides you with a third-party credit assessment. Credit risk management can be defined as a logical and systematic method of identifying, analysing, assessing, monitoring and communicating associated debtor risk. And how do we do this? We do this through undertaking checks on the correct legal entities. We provide investigation, company and business report searches. We do debtor analysis. We also do credit limit assessment and financial analysis. Where necessary, and for large exposures, we undertake direct approaches to the debtors to obtain operational and financial information. This task can easily be more successful if it's carried out by an independent third party. Clients don't tend to like supplying their financial information to who they're working with. We can also provide informed commercial credit opinions on entities. Our decisions are very impartial but commercial. We are removed from internal pressures of many clients' credit management processes, such as credit managers versus sales staff. Also, it provides you a great third-person blame when you're negotiating with your new debtor. And this is our process flow chart that we go through when assessing a new customer. As you can see, initially we confirm the legal entity. We source credit information through an external reporting agency such as Vita or Dun & Bradstreet. We then gather trade references. So if they've supplied you trade references, we'll follow those up, but we'll also check our own sources and other clients who may be dealing with them. And the next step is gathering information from our own sources. This is what really separates us from our competitors. This information comes from our many credit insurance clients. What we can see and establish is if the insurers are running cover on any buyer, or if any adverse information has been reported on a client, or if collection action has been taken. With a credit insurance policy, you must report an account that breaches 60 days past due date, and you must report an adverse event such as a bounce check, a direct debit fail, if someone asks to go into a repayment plan. You have to report this so claims are paid, and what we do is capture this information to assist with our credit assessments. We then have a risk manager assess all the information and provide a credit limit recommendation, and it's not a computer-generated report as with other providers. And once we provide our assessment and recommendation, we continue to monitor your customer for adverse information. Company circumstances can change for a wide range of reasons, and this is why it is so important to have monitoring services in place to alert you to these changes so you can make an informed decision on managing credit moving forward. So often I hear, "No, it's all right, I've been dealing with this company for years and they've been great payers." And then 6 months' time, this is the company that goes insolvent. Just because you've been dealing well with a company for years is no precursor to future performance. This was evident recently with the GEON insolvency in the industry, where there's tens of millions of dollars of unsecured creditors. In regards to monitoring, what you should do is monitor for adverse information and structural changes. You should keep an eye on who the payments are received from. For example, look for changes in payer details on cheques and FT receipts. Get notifications of changes at ASIC. A resignation of director. You may require a new guarantee to be completed. Maintain contact with other suppliers, networking, trade bureaus, the Printing Association. And make sure you stay in contact with your customer. Maintain that relationship. And also keep an eye on changes in payment patterns. And finally, report overdue accounts. Let other people know that you're having trouble with this buyer, and monitor through NCI. As discussed previously, part of our credit insurance that is people that has to report an adverse event or an overdue account. This comes through our system, and what we do is alert any other customer who we know is dealing with that buyer. The reason we do this is so you guys can make a fully informed decision, and so we can try and limit losses before they happen. It gives you the information to put processes in place to try and reduce those losses. It helps you avoid problem payers. Also, we alert you to any changes in company structure or any changes through ASIC. This proactive approach is all about limiting losses before they happen and alerting you to act quickly on troublesome accounts. But you also have the ability to report overdue accounts through the NCI Net. I'd just like to share you a case study which highlights the benefits of monitoring. I've chosen one from a couple of years ago. However, this scenario we come across quite a lot. One of our clients came to us in February 2008. They asked for a $120,000 credit opinion request on HMG Westall Pty Limited. They had orders on hand of $114,000 for this new client. Our credit risk management recommended a limit of $120,000 on the 15th of February 2008. We continued to monitor. Our client had ongoing business with this client up until February 2009 for 12 months, when we then advised that we had become aware of adverse information. That was through other clients reporting overdues. On the strength of this information, our client stopped further deliveries and gradually reduced their exposure to nil in early May. So it took them 3 months to reduce their exposure. But an administrator was appointed to HMG Westall on 26th of June, a month later. Thanks to that early warning sign and that alert, our client had no money owing to them. So as I said, this scenario we come across a lot and does highlight once again the importance of monitoring. But of course it's not foolproof, as there are many clients that show no signs of distress. And finally, you should act quickly on overdue debts. Age is the biggest deteriorating factor in the collectability of an account, as you'd all be aware. If you allow an account to go to 30 to 60 days beyond due date, you greatly reduce your ability to recover your money. If customers are having trouble paying on time, they're most likely not paying other creditors either. Acting quickly on an overdue account and staying in touch with your clients means you'll remain at the top of the pile. You should never be discouraged when chasing money. Never be discouraged from asking your customers for payment. Businesses who don't follow up get paid last. And having good processes for actively chasing debts is the best way to keep your debtor ledgers in control. And advise your customer of the next step if their account remains unpaid. You can specify consequences for missed payments, including the impact of their ability to obtain credit in the future, as you can report them to a credit reporting agency. Also, you should use a subscription tool to a credit reporting agency to receive adverse reports. And also, if you have no success, then a referral to a collections agency can help. Finally, our collections module. NCI offers basically a free service where there's no joining fees and it's based on a no success, no fee basis. you do only pay on collected results. We do charge a competitive fee of 10% commission on money recovered with a minimum of $100 and a maximum of $4,950. If you have it in your terms and conditions that if an account passes onto a collections agency, then any fees will be passed on to the debtor. Then in most instances, NCI collects our fee as well, so it ends up costing you nothing. Basically, our recovering procedures and how we work is we issue a 72-hour letter of demand, we make phone contact with the debtor, then we negotiate for settlement of the debt or a repayment plan with your approval, and as required, we send a notice of intention to commence proceedings if we're having no success. With NCI collections, we do tend to have a better success as companies are aware we're related to credit insurance and the insurers. And what happens is if a company gets reported to a credit insurer, then their limit will be pulled from every supplier that is supplying that company, and it puts too much pressure on them. You tend to find companies that have credit insurance tend to get paid before people that don't, because companies don't want to get reported to the insurer. But if all avenues have been exhausted and the debtor does not make suitable payment arrangements, we will commence legal action only with your consent. So basically that is the end of our webinar today, just covering off a few key topics of why it is important to have good credit management processes in place. NCI has done negotiated a fantastic deal for all printing industry members where we do provide you access to NCI's suite of products. Our credit risk management service is for $750 for a 12-month subscription. The normal price of that is $2,500. And this provides you access to our database of information. We will monitor your top 25 customers for adverse information. I believe this alone would be worth the money spent in monitoring those top customers. You can also purchase credit reports through our database at reduced rates, and you can also take advantage of our collection service as well. So thank you once again for attending and listening to the presentation, and if you have any questions, please send them through to me.
Thank you for that, Mark, and we have had some questions come through. Firstly, is there a cost to register with the PPSR?
There are government charges, yes, there are, and it ranges from how long you want to register, because you can register for 5 years, for 7 years, 25 years, and indefinitely. I don't have those charges with me, but I believe for registering for 5 years, the initial one, it's about $8 per registration, and it goes up from there.
Okay, thank you. Next question. Should you monitor customers yourself, or should you ask your buyer to provide you with all of this information regularly?
Sorry, Yoshi, you dropped out.
Sorry. Okay, let me say that again.
I've lost you.
Can you hear me now?
I've got you back.
No problem.
Yes.
I must have pressed the wrong button. I apologize. Okay. Should you monitor customers yourself, or should you ask your buyer to provide you with all of this information regularly?
Well, I believe you should put processes in place so you monitor your buyer yourself, because you don't want to really upset your customer by always asking them for this information. And if a customer is getting into trouble, then they're not going to actually tell you this information. Some will be up front, but I believe a lot won't. So I believe it's best that you do put processes in place yourself to monitor and also assess the risk. It's actually up to you to assess credit risk for your company.
No problem, thank you. And it looks as if we're up to our final question, which is, I guess, sort of linked to the previous one. To know your buyer, is industry market research useful, or should you only get individual data from each person and company who you are dealing with?
No, I think it's all. The more information that you can gather in managing and assessing your credit risk, the more helpful it is. So yes, definitely industry information is very important. You know, currently, for example, in the building construction industry, margins are very tight. There's not a lot of work around, and that's putting pressure on all companies within that sector. But not only should you look at industry sector and that, but you should also assess the client and the customer on its own basis.
No problem. Thank you very much. And it seems as if that's it for all of our questions. So thank you very much to our presenter and to our audience. And we look forward to seeing you all next time. That's it from us. Goodbye for now.